Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
And hello and welcome to this episode of the FedLife Podcast. I'm your host, Dan Sipe. Additionally, as you know by now, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates, beginning as I always do with saying thank you. Thank you for taking the time to listen because you really are doing that. We'll get to this in a little bit, but I'm seeing the numbers go up and hours of listening each month, which warms my heart to see. So thank you for taking the time to do that. We will do our best to keep coming up with great content for you. And also, as is my want, thank you for your service. You simply don't hear it enough. You should hear it more. I do my best to make sure other people understand it, but you will always hear that here. And the other thing that you always hear here is the guru, Ed Zerndorfer. He's back with us again as part of our ongoing mission to reach, teach, and serve you. Here comes the compliance comment. And at the outset, I need to say the opinions of our guest, Ed Zerndorfer, are not the opinions of Raymond James of Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if by some chance you do not have a personal advisor, hit us up at Serving Those Who Serve. We will do everything we can to help you. Once again, we will follow Ed's FedZone articles, another way for us to reach, teach, and serve. And here we go again. I know the rules. I know it's podcasting 101 that I am never supposed to acknowledge a current date, current time, weather, anything. But if you listen to me for a while and you listened to me at this time last year, you know how I feel about the holidays. So I don't care. It's the holiday season and I'm breaking the fourth wall. And in this particular case, I am super excited because Ed and I are going to be talking about one of my favorite topics, which is charitable giving. So Ed, before we get to that, I just wanted to let you know that for last month, we had 1,200 listens on the podcast that we put together for almost 5 hours of listening time. I think that's pretty awesome.
That is awesome, man. I'm so glad to hear that. And most important, I'm glad that people are getting a lot out of these podcasts, and hopefully this is going to continue way into the future.
From your lips to God's ears, my friend. Let's move on with the topic of charitable planning, because Ed, we've got a little bit of an unusual opportunity this year, and that is that Uncle Sam is giving an additional incentive to give. Is that correct?
That is correct, Dan. As a result, mainly of the COVID, what happened over the past year or so due to the COVID pandemic, Congress passed some legislation that makes charitable giving a little more, let's say, an incentive for employees to give to charity because they'll save on taxes. Not that should be the reason that we give to charities, Dan. The primary reason we give to charities is for the sake of giving to helping our fellow human beings in their dire need. But it's nice to know that we're getting some tax relief when we're doing so.
Sure. And so let's start with the basics. Back in 2017, the Tax Act raised the standard deduction amount. So I know just from my conversations with charitable organizations at our firm, we do an awful lot of charitable planning, that did impact things a little bit because the charitable deduction for a lot of people fell under the standard deduction. So this year, there's a change, though. So even somebody who's taking that beefed up standard deduction that everybody got in 2017, they're going to be able to deduct some charitable contributions, correct?
That is correct, Dan. Let's just go back to what happened in 2017 when Congress passed the Tax Cuts and Jobs Act of 2017. Well, let's remember, as a practicing tax professional here, I do a lot of tax returns. We have an option when we file our taxes, federal taxes, to either take the standard deduction or to itemize. That is, file Schedule A. And the rule is that we if it turns out that our itemized deductions exceed the amount of the standard deduction, then it's to everyone's advantage to take their itemized deduction, Schedule A, and to deduct those itemized deductions from our income so that we pay less income tax. On the other hand, if our standard deduction exceeds the amount of our itemized deductions, we are better off from a tax standpoint, saving on taxes, to take the standard deduction. That being said, one of the items that is included on Schedule A, your itemized deductions, are charitable contributions. Charitable contributions. That's one item. The other item is medical expenses that exceed a certain amount of your adjusted gross income. State and local income taxes, property taxes, and mortgage interest are among the items that are included as part of item one's itemized deductions. When Congress passed the Tax Cuts and Jobs Act of 2017, what Congress was trying to do is to make our taxes a little more simple. That is, that we take the standard deduction instead of itemizing. The whole purpose, I don't know if you recall, Dan, that Congress really wanted to make our tax returns in the form of a postcard to really cut down so far that has not happened. But I will tell you that as a result of Congress doubling the amount of the standard deduction for single filers and married filers, a lot of people who would have normally itemized, they had enough itemized deductions, it turned out that their standard deduction with that doubling was more than the total amount of their itemized deductions. Therefore, anybody who took the standard deduction, who made charitable contributions because they did not itemize, would not get any type of tax savings resulting from those charitable contributions. So, in 2020, right after the pandemic had started, Congress passed the CARES Act, and one of the provisions of the CARES Act was the fact that individuals who take the standard deduction would be allowed to deduct a certain amount of their itemized deductions, a certain amount of their cash and check charitable contributions, and take it as part of their adjustments to income. And how much was that for the year 2020, Dan? It was $300 whether you file as single or married filing jointly. That $300 deduction was an adjustment to one's income. It was not an itemized deduction. It was an adjustment to one's income. And a lot of people took advantage of it. For this year, however, 2021, the same deduction, $300, applies to each individual. And if you file married filing jointly, that's $600. Again, it was a deduction. But in this case, for 2021, it was not an adjustment to one income. It did not reduce your adjusted gross income. It reduces your taxable income. That's the difference.
So
but
it's below the line.
2021, so-called below the line deduction, but only for 2020. There's no guarantee this is going to happen beyond for 2022 and beyond. It's only for this year.
Sure. Okay. And we'll dig into these in a little bit of detail. But you also mentioned that there's a higher ceiling for the percentage of charitable deductions relative to income. It's usually capped at about 60%. What is it now?
Until this year, it was for those people who itemized, Dan, the total amount of their charitable contributions, which, by the way, would include cash and check donations, goods and goods that you donate to a charity, or stock, bonds. We're going to talk about that in a few moments. Appreciated security was 60% of one's AGI. Again, only for people who itemize. That 60% of one's adjusted gross income was the limit. For 2021, Dan, only 2021, it's 100% of one's AGI. You could donate, if your adjusted gross income is $200,000, you can donate to a charity $200,000, up to $200,000 total. And this way, your tax liability, Dan, is reduced to zero.
Yeah. Wow. That would be some exceptional generosity. I kind of want to meet that person if they're out there. To sort of jump back to our standard deduction folks, they can give $300 per person, $600 for the couple. And that's going to be a deduction in addition to the standard deduction, which is going to lower their taxes, correct?
That is correct, Dan.
Okay, that's awesome. So folks, hustle out there, pick that charity that you've been meaning to do something with. One of the things, and maybe it's just me, but I don't think I'm that different from everybody else. I start coming into the end of the year. Well, first off, at my age, I'm glad to be coming to the end of the year still here. That's one of the number one things that I'm always trying to be thankful for. Number two, if I count my family on January 1st and I got the same number of family on December 31st, again, another huge blessing. But no matter what kind of year I had, I always get this sense that there's a whole lot of people that had it worse than me. So this is just a decent time for reflection, and I'll encourage everybody to do the same thing. So basically, I had the standard deduction folks get that $300, $600. Itemized deduction people get a higher threshold than they've ever had before. So it's from 60% up to 100%. Now, there's something in here that was kind of neat. I really want you to take a little bit of time on it. You were talking about bunching contributions. So why don't you talk a little bit about that? Because I don't think a lot of people would come to that idea on their own.
Well, I tell you, Dan, I had this time of year, I'm having quite a few meetings with clients about saving taxes for 2021. And for my maybe upper income individuals who do itemized, they're looking to get all those deductions because they're afraid they're going to be pushed into higher tax brackets if they don't. I suggested that they try to contribute as much to charities as much as possible. If necessary, what they were planning to give in 2022, that they make it in 2021, in this month, before December 31st. So, for example, they were planning to give to charity this year, a total of $20,000. And in 2022, they wanted to give, let's say, a little bit more, maybe $25,000. What I suggest they do is somehow take part of that $25,000 they were going to give in 2022 and bring it into 2021 this month. And they said, well, I don't have that kind of cash. I will have it in 2022. So I tell them, well, I know most charities will accept the credit card. And all you have to do is to charge the amount that $15,000 that you would have put in 2022 and charge it in December 2021. You get credit for the donation because when you use a credit card, the donation that you're making will be credited for the year that you made the charge, not when you paid the charge. You're going to pay the charge in January 2022, no problem. This way, you get the best of all worlds. You get the donation, and you're actually able to pay it in 2022 when you have the cash. And by the way, you may earn a few points. You may earn a few points in your credit card, too.
Sure. Oh, believe me, I love points from charity, Ed. I like points in general, but I really love it from charity. So okay.
Again, Dan, I have to emphasize this opportunity of 100% of AGI, 100% AGI. As of now, that benefit is going to be over. Come January 1st, 2022, we revert back to the 60% of AGI limitation. So this is a once, I wouldn't say once in a lifetime. It may be renewed, but there's no guarantee.
Gotcha. Let's press on with your article, because then you get to something that we are very keen on here at Serving Those Who Serve in LSA, and that is giving gifts of appreciated stock or mutual funds. A lot of people don't think about this, so why don't you walk folks through what it is and why it might be a good idea?
Those individuals who own appreciated publicly traded stock, it has to be a publicly traded stock, that they have owned for at least 1 year. They bought this stock, their original purchase was more than a year ago. They can actually donate the shares of that stock to a qualified charitable organization. In so doing, they will avoid paying capital gains tax on the stock appreciation. Because keep in mind, Dan, as you know, if you're holding a stock outside of a retirement account, you have a brokerage account, and you're so proud of yourself because the stock has gone up in value, it's appreciated. If you sell that stock, you're going to incur what's called a capital gain, and you must pay capital gains tax on your capital gain, net gain. In this case here, if you were to donate the stock to the charity, you will get a deduction equal to the fair market value of the stock on the day that you donate it to the charity. And if the charity then sells the stock, gets the cash, the charity would not have to pay the tax because they're a charity. Law charities do not pay federal income tax. So we got the best of all worlds.
Absolutely.
What I advise my clients, Dan, to do is that if they have stock shares, let's say, that have gone down in value, and they were to sell those shares, they will incur a capital loss. The capital loss they incur as a result of selling those shares would offset any capital gains they have from other things they sold at a profit. But if they don't have enough gains, enough gains to offset the total amount of loss. At the very least, the individual, the stock owner, can take the net cash they have from selling those stocks and donate it to a charity. And then they'll get a deduction for a cash contribution. Any type of publicly traded stock shares that have gone up in value, the stocks that you own for at least 1 year, for 1 year, in terms of taxes, you're best off donating that stock to a charity and get a deduction equal to the fair market value of the stock. Or stock shares that have gone down in value. Again, you've held for at least 1 year. You would sell them, take the loss, the benefit of the capital loss in one way or another, and then donate the net cash you got from selling those shares to a charity, and you'll get a deduction. This way you get, in a sense, a double deduction.
Sure. Nope. And I love that. And I also love that you put in your article, so I'm going to plug it here, which is, folks, do not call your broker on New Year's Eve with this. Think starting around Thanksgiving, because it can take a little bit of time to do these transfers. I appreciate that you put that in there. And for all of my brethren in the financial services industry, I will put this out there. If you don't get around to listening to this until New Year's Eve, don't call your broker right then, because he's not going to be able to do it, but it'll still be a great idea for the next year. This is just a little tickler idea. If you want to learn how to use appreciated securities in place of a cash donation and use a strategy whereby you can actually increase the cost basis of your holdings and do something great for the charity, hit us up at scwserve.com. Let them know you want to talk about donations of appreciated securities. And even if you don't want to work with us, we'll explain it to you, because it is a very cool way to do good and do well. And so we're very excited about that. Next, Ed, in your article, you talk about qualified charitable distributions, QCDs. Many of our folks may not know what they are, so tell us about them.
Qualified charitable contributions. This basically is a means of donating parts of your IRA to a charity. Now, when I say an IRA, I'm really talking about a traditional IRA. And the reason I'm talking traditional IRA versus a Roth IRA, there are tax benefits when you contribute your traditional IRA to a qualified charity. And what are those benefits? Well, if you were to keep that IRA, I'm talking about parts of your IRA, and let's say take a distribution, Dan, you would have to pay tax on the withdrawal. You have to pay tax. And then once again, you could take that money and, if you itemize your taxes, contribute it to a charity, and you would get a deduction. Depending on whether or not you take the standard deduction or itemize, let's say you itemize, you would get some tax relief by donating the proceeds. But on the other hand, if you are at least age 70 and a half, and you were to say, I want to take part of my IRA and just donate it for a qualified charity, you would not get a charitable contribution, any type of tax relief in the form of a charitable contribution. However, what would happen is that when you would eventually have to take out that IRA money, you'd have to pay tax. You say, why would I have to take out the money? Well, Dan, if you reach what's called your required beginning date, in which you have to start taking a required minimum distribution from your traditional IRA, then the higher the amount of your traditional IRA balance, the larger your required RMD, required minimum distribution, more taxes would have to be paid. By starting to do these qualified travel contributions starting at age 70 and a half, it will cut down the value of your traditional IRA, meaning that when you start taking RMDs, and for most people now, it's going to be starting, the first one is due no later than April 1st following the year they turn 72. Like, for example, I was born in January 1951. My first RMD from my IRAs is due no later than April 1st, 2024. So what I'm doing now is I am starting to do these qualified charitable contributions because I'm over 70 and a half and giving them to my favorite charities. And that's cutting down the size of my traditional IRA account. And that means that when I start my RMDs will be less because my IRA balance will be lower as a result of transferring my traditional IRA over to the qualified charities in the form of the qualified charitable contributions. I want to emphasize, Dan, I'm talking about IRAs. Those people out there, I know employees have their traditional TSP, they have traditional TSP, and they're saying, well, can I do that with my traditional TSP? The answer is no. It has to come from an IRA. But what a federal retiree can do is they can transfer their traditional TSP to a traditional IRA. You're allowed to do that. And as long as it's a direct transfer, Dan, there's no tax consequences. That once they turn 70 and a half, they can start transferring those traditional IRA accounts to a charity in the form of a qualified charitable distribution, and that will cut down the amount of their TSP R&D because that money was no longer in the TSP account. It went out to the IRA, now went to the charity. It'll cut down the size of their TSP R&Ds.
Makes sense. In this article, you kind of round out with another thing that a lot of people don't know about, but they are just an awesome tool, and that's the Donor Advised Fund, the DAF. So lead on, Guru. Tell us about them.
A Donor Advised Fund, or short, a DAF, it's an account in which an individual, I call that the donor, deposits financial assets for donations to charities over time. Now, the donor gets a tax deduction for making contributions to the DAF. There has to be a sponsoring organization managing the account. What would be a sponsoring organization? A brokerage. I'm sure people have heard of, can I say it, Dan? Raymond James?
I've heard of them. Ed.
I don't know if they do these donor advice. I have a feeling they do. I'm not sure. I'm not trying to make a plug for Raymond James here.
And there's actually, to be fair, there's plenty of places that do them as well.
I know Vanguard. I know Charles Schwab. All these companies do have donor advised funds. We're not going to pick any one, of course. They're all good, and it's your choice. But a sponsor organization has to manage the account. Okay? Now, the donor can recommend to this sponsor organization how to invest the assets. It's like a brokerage account. And most importantly, which qualified charities to donate the assets. Okay? And just keep in mind that once any of the financial assets that are put into this DAF, the sponsor organization has legal control over that. But as long as the donee is a qualified charity that is recognized by the IRS as a charitable organization, the sponsor organization will usually use the donor's charities of choice. Now, what can be deposited into this DAR? We're talking about cash.
Oh, yeah.
Stocks.
Yep.
Bonds.
Yep.
Open-ended funds.
Yep.
You can put your IRA account there. You could put money from the TSP. You could transfer money from the TSP into this account. private company stock, cryptocurrencies, and life insurance policies. Yes. Okay. That goes into the account, and you will get a deduction. The donor gets a deduction for anything that's deposited into the account. I shouldn't say in the money, but the money that's paid out to the charity, they get a deduction for it. The money going to the account, and then it's invested, and then the donor says, listen, I'd like you to take so-and-so X stock or cash and put it and give it to this my favorite charity. And that's what, at that point, the amount that's transferred, they'll get a deduction for.
Absolutely. No, they are terrific, terrific, terrific tools. And folks, this is really just the tip of the iceberg. As a matter of fact, we've got a little bonus topic here, and we will not be able to do this justice. But if some of these things have kind of gotten your wheels turning, the big thing that we want to do is get terminologies out there and give you an idea of what they mean. And this one is a favorite here at SCWS and LSA. That's the Charitable Remainder Trust. Basically high level, and then I'll let Ed jump in. If there's a charity you really care a lot about, you would like to help them as part of your estate plan, as part of your retirement plan, you do have the ability to give assets or money or what have you to a charitable remainder trust and actually receive income from it until such a time as you pass away. Then the asset goes to the charity. There's rules about how much of that is deductible and everything like that. But most people don't know anything at all about this. They simply don't know a fantastic tool like that exists. So Ed, about a paragraph, what are your thoughts on CRTs and just quick flyover for folks?
In 3 words, Dan, I love them.
Okay. That's my man.
In short, what is a charitable remainder trust? In short, they are what I call an estate planning tool that allows someone to earn income now while they reduce both their income tax now, whatever they do right now, what they're paying income tax on their as well as estate taxes after one passes away. Essentially, it's a win-win-win situation. Okay, these are basically the charitable remainder trust is what I call it's called an irrevocable trust, and it's set up specifically to distribute income to a named beneficiary. It could be yourself that sets it up, or somebody else you set for a set duration of time. At the end of that time period, any value remaining in the trust is dispersed to a predetermined charity. People ask me the question all the time, well, what's the difference between a trust and just a regular trust and a charitable trust? The biggest difference between a standard trust and a charitable trust is that charitable trusts can last forever, which is not always the case with respect to a private trust. The designated trustee and beneficiaries of a private trust they exist to carry out the trust. With charitable trust, if it is the state attorney general, whoever represents the public interest, who administers the trust. Essentially, it's just a great tool, both currently and in the future. Because a lot of people like to focus on the current in terms of getting some benefits when they donate to a charity. Well, that's fine. But they don't think about, when they pass away, how their estate's going to be transferred to loved ones in the least costly fashion and not have to pay either federal estate tax, because we still have a federal estate tax in this country. People think, well, I'm not worried about the federal estate tax because the exemption, they told me, is $11.8 million. I'm not going to have that much. Or if you're married, you can double that to $23.6 million. That's true, but Dan, there's legislation that's going to bring back that exemption down to $6 million.
Oh, yes. Oh, yes.
It's in the works. It's in the works. It may happen as soon as 2026. So, and a lot of people think about this thing. What has happened to the stock market over the last few years? Their estates have shot way up. They got to be thinking about this. What's going to happen in the future? So, in my opinion, the benefits of the charitable trust, in summary here, they reduce income taxes now through the way it works is you get a charitable income tax deduction. The way the trust is up. You can convert appreciated assets within the trust or assets into something that offers lifetime income. It eliminates capital gains when those assets are eventually sold. It benefits a charity or charities, okay? And something else that people have to keep in mind, that because the charitable trust is an irrevocable trust, it gives protection against creditors for the assets inside that charitable trust. Those assets that go in there, if you get sued with a regular trust, or let's say a revocable trust, somebody could, if you get sued, if the owner of that trust gets sued, those assets are fair game for the creditors and creditors. Not so with the charitable trust, because that's an irrevocable trust. And two other things, basically you can earn more income now and throughout your life than you would if you sold the assets on your own, outside of a trust.
Very true.
And finally, it allows a charity to plan for your contributions, expecting future benefits from the trust. In other words, the charity knows they're going to get those assets eventually.
Absolutely.
And they can plan accordingly for their benefit. It's just a win-win-win situation, Dan.
Folks, since this doesn't follow one of Ed's articles, it's just an area, as you can tell, we're both passionate about. I will drop the Ed Zerndorfer cautionary point here, which is make sure that you're talking to qualified professionals about this. Just because you listen to Dan and Ed, don't go, hey, set me up a charitable trust. You need to work with your accountant, work with your attorney, that type of thing. But what we want to do is just raise awareness so this conversation begins. And he'll get mad at me for this, but my partner, Tom Lee, is Mr. CRT here at Serving Those Who Serve. You know, he's very gifted in the area of charitable planning. If that's an area of interest or passion for you, give us a call. We'll help you any way we can. If you want to work with us, great. If you don't, we'll just help you understand what you can do. But again, it's my favorite sentence, to be able to do good and do well. And that's just, as Ed said, that's just a great thing. Well, Ed, my friend, we've made it through another year together. The last two have been a little bumpy and anything but Dell. But I can tell you, I can't think of anybody that I would rather have made this journey with than you. It's been awesome.
It's been a pleasure, Dan, working with you throughout the year. I could look forward to many years together, doing these columns, doing the webinars, and, of course, the podcast here. It's always a pleasure.
Absolutely. Amen. I couldn't have said it any better. Here's to 2021. It wasn't perfect, but it could have been worse. Now, speaking for myself, I'm looking forward to 2022 and whatever new normal is going to look like. We're going to keep our eyes up and our thoughts up to head into the new year. We'll have another podcast that you folks can listen to. That's going to deal with some year-end tax ideas. And after that, we will be back in the new year. So once again, breaking the fourth wall, all the rules. Have a great holiday season. We are Serving Those Who Serve. You're already doing it. Tell your friends to subscribe to us on YouTube and Spotify. Share it with friends and strangers. Don't forget us on Twitter, LinkedIn. And as Ed touched on, we've got the live webinars every week. They're going to keep going through the new year. Go to scwserve.com. You'll see the webinar button for registrations. Click it and you'll be off and running, and the guru will come to you. Sign up for one, sign up for all, share it with your friends. You can read Ed every single week in the Fed Zone at fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, it's your Fed life. Make it a great one because you deserve it. Happy holidays. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations. Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.
Donors are urged to consult their attorneys, accountants, or tax advisors with respect to questions relating to the deductibility of various types of contributions to a donor-advised fund for federal and state tax purposes. To learn more about the potential risks and benefits of donor-advised funds, please contact us. Please be aware that there may be substantial fees, charges, and costs associated with establishing a charitable remainder trust.